Hey guys, I wanted to talk today about one of my favorite traders, Bill Ackman. For those that don't know who he is the CEO of Pershing Square, and he has been a very prominent, very public trader for a very long time. More recently, he got into a very public spat about Herbalife, which you can do some research on and read about, but he took a big loss trying to short the stock. Over $1 billion he lost, along with people that left his fund because they lost faith in him because he lost so much money. It was very public too. He was in a spat with Carl Icahn about it. And yet he came back from that loss this year to make over $2 billion on the COVID crash. That is impressive. That is a trader, somebody that can take a loss and come back from it even stronger. A lot of respect. He's one of my rock star heroes. And so I'm going to naturally follow what he's doing and learn from him as best I can. And so I'm going to look at what he talked about today, the trade that he is in, a macro trade. And this is going to be something where, disclaimer, this is not something that I'm recommending that anyone do without due diligence, but I wanted to use this as an exercise to explain what some of the thought process is and how to interpret some of these things that people might not understand, because I had to sit down and actually do the research myself to understand what it meant. And let's just take a look at the article here. So on CNBC, he had a interview today where he was talking about the IPO of his new fund, his Pershing Square Tontine Holdings. It's going to be an acquisition company. I've read about it, but it's still a little bit above my pay grade in terms of what it means to invest in this company. I want to, but I need to understand exactly how this company works before I put any money into it. So that's going to take a little while. But what he talked about here was his overall strategy, and I agree with him about being bullish on America. Unless you don't think that America is going to be here in 10 years, then I think being bullish on the stock market has been a really good strategy for the last, 40 years. So the other thing he talks about was having a short position in a high yield index. Now, what does that mean? High yield means typically, in relation to bonds, a very high interest rate on the bonds. And the reason that the bonds would have a high interest rate is because the credit rating of those bonds, and in this case, he's probably talking about corporate bonds. So the credit rating of those companies is going to be rather low. And so because they're low, they're considered to be higher risk. And so people that want to put their money with these companies are going to demand a higher return, a higher yield on the bonds that they take out with these companies. So how can I find out what a high yield index is? Well, my favorite website for looking up ETFs is going to be this one. So I like going to etfdb.com to do some research on ETFs. Now, most of the time you can pull some good information. They do have premium features that let you look at all the holdings, etc., but you can see a lot from here. And basically, if you want to look at the biggest high yield corporate bond ETF, it's going to be HYG. There's another one. The second one is JNK, junk. So if we just take a look at this, basically this is going to be an ETF that tracks the corporate bonds that have very high yield. And what I like about this is it has a lot of volume. We won't have to worry too much about liquidity. So if we look at HYG on the chart, and I'm using thinkorswim to do my analysis, it looks oddly similar to the S&P index, or basically the market as a whole. I mean, we have the top here in February of this year, comes down to a March 23rd low, and it's slowly gone up from there with a little dip that we had in June. So go back to HYG, and it looks very, very similar, actually. What he's doing by going short the high yield bonds is he's basically taking out a hedge against the market as a whole, because he's long a lot of stocks, and so he needs some way to hedge that. And this is what he's identified. Now, if you go back and read the article on CNBC, which I'll link, you'll see some of his logic behind it. He's actually very generous in telling us what he's thinking with that. And there's another thing that I like about this, from just looking at what I like to look at in options, which is the IV rank. So if we look at the SPY, the IV rank of the options on SPY right now is at 20. And what that rank is, the relative pricing of options over the last year. In other words, it goes from 1 to 100. So 100 being the highest that IV has been. In other words, the options would have been the most expensive they've been. So back here in, of course, March, when we were tanking, the IV was extremely high. But now we've come down to where it's really kind of normalized, and we're actually well below the highs of the year. And so that's what the IV rank means. We're at a low relative point in the pricing of options. Options are cheap, or at least cheaper than they have been for the last year of trading days. And so if we go back to HYG, we look that the IV rank is actually even lower. So the options on HYG are even cheaper. So if we were looking to take a hedge against the market and we were looking at just the relative option pricing, this would be a very good choice. So if I want to emulate Ackman's trade, I don't want to necessarily just short this stock. I want to do it with options because, as I've said, the options are relatively cheap compared to where they have been. So it's a really attractive prospect. And what happens if you're buying puts, typically when the market goes down, IV increases, so you get that double bang for your buck. So it makes for a really good hedge, even more so than taking the SPY. And I need to pick some targets, like in terms of strike price. So what I'd be looking at is something, around the June lows right here, okay? And then also we could look towards something a little bit lower. And I like these because basically the June lows are where if we come off the high that we're up right now and come to here, basically this would just be us completing the consolidation. And if we go a little bit further, given a little more time, we can come up to basically this inflection point right here. I like these levels in a very simple technical analysis standpoint of highs and lows, and it makes a good line in the sand that we can look at going forward. So if I look at what these prices are, it's basically 81.5 and 78. Those are going to be the two targets if this thing goes down, what we need to target. And if we just think about it, like how long is it going to take to get somewhere? Well, we can't say it's going to come immediately down here, but so we're going to go a little bit further out if we're trying to play these two levels. And obviously, if it does go down, we're going to assume that it comes to the first level in a relatively short amount of time and the longer term level in a longer amount of time. So let's look at the option chain for HYG. And I'm using Thinkorswim again. I think they have some of the best options analytics out there. Remember, we're looking at these two levels at two different points in time, and I'm taking options pretty far out. And the good thing about this is because IV is so low, even though we're taking options really far out and far out of the money, we're going to get a pretty good price on them. And if we look at, say, the January, the leaps, I'm liking the spreads. The spreads are pretty good. A 16-point spread right here. It's not where I'd like to see, within 5 cents, but we'll go with it. And so if you remember that 78 was my target level. So just to give myself a chance for that to go in the money if it hits my level, let's look at the 79. So we could probably get that for somewhere in between here. This is at the close, by the way, of July 22nd, 2020. So we're looking at closing prices. $2, let's just give it, if we were to get into this one. So this would be the longer term contract that we'd be looking to get into. All right, and then also if I was looking for a shorter term play, remember the first level we were looking at, which is 81.5, then I might go somewhere a little bit closer to the chest, like an October or a November. As a personal preference, I'm going to choose a November because if I'm looking for a bearish move, historically October is a crazy month. And so I want to try to capture that in case we have some big October down move. So for that 81.5, chance to go in the money, we'd be looking at something like an 82. And so let's just take a look at this right here. So we add this in. And what I can do is I can go into Thinkorswim and its risk graph and see how this plays out. So I'm going to add this one to the risk graph, and I'm going to add the other one as well. And so here's what the risk profile is going to look like for this. Now naturally this is a fixed risk trade, so the most we're going to lose is the premium we pay. Oh, let me change those. There we go. So the most we're going to pay is this right here. And remember, our two targets are going to be basically 81.5 and then the 78. So we can see what happens here. If we take these all the way to expiration, then we're going to need to have a down move to make some money. So how we can use this tool is we can go out to different dates and see what money we would make or lose based on the time. And this is going to be using theta and delta as an estimate. So you can't really assume that it's going to be exactly accurate because we're not really taking into effect the volatility. You can actually add volatility adjustments here, and of course, if volatility increases, so too does the price. But we're just going to leave that the way it is and just operate on the basic Greeks. And so if we were to actually get a big move down, by August, we're going to actually start making some pretty good money on either one of ours. Basically, if we look at them individually, they're going to be, there's 63 if we're taking the longer dated one, and the shorter dated one's 95 because it's shorter dated, of course. And so put together, that's what we would end up making. And as time goes on, of course, the rewards are going to be much less because we're eating a lot of theta with this position on. But again, it's a fixed risk position, and you should be using it like Ackman is using it as a hedge. And so you already have a lot of bullish stock positions, and this is basically just trying to ensure a little bit of your downside. So I hope this helps people understand what it means to have a position in a high yield index. Basically, a lot of people want to either bet on the market going down or hedge their existing portfolios. And this is a good thing to look at, but you need to look at things outside of, say, just buying SPY puts. There are a lot of different ways that you can express your hypothesis, and this is one of the ways to do it. So my hope is that I've helped people kind of understand what Ackman was talking about, as well as expanded their horizons in terms of how to play different hypotheses in the market.